Here's the biggest lie in trading. You are told to buy when the market is oversold and to sell when the market is overbought. But it doesn't work this way, I'm afraid. If you want to slowly lose your money using this technique, go ahead. But what if you did the opposite? You sell when prices are oversold and buy when prices are overbought. Could this work? Let's find out. You know the drill. Like, subscribe, and stick around for the full video. For this experiment, we'll use the RSI. Every serious trader should know about the RSI, or the Relative Strength Index. The problem is that not everyone knows how to read the RSI, and this is especially true for beginners. RSI basically measures how fast trades happen and how fast the price moves. The indicator moves on a scale of 0 to 100. If the readings drop below 30, they say market is oversold. The readings at 70 or higher indicate overbought conditions. Here's where most traders are getting it wrong. These values indicate past price movements, but don't show any future price direction. A value above 70 or below 30 isn't necessarily an invitation to enter a trade. A market may stay above or below these levels for an extended period of time if the trend is strong. Many traders are still using this strategy because it's promoted in almost every trading book. So let's do the opposite. We'll look to buy when the RSI goes above 70, and we'll sell when the indicator crosses the 30 level. Here's the logic behind this strategy. When the RSI reaches the overbought and oversold area, it means the recent price movement is extremely strong. In case of an uptrend, this means that the price is currently pushing into new highs. From now on, when we see overbought, we see an extremely strong trend that is moving higher with a strong force, and vice versa for oversold levels. We'll try to profit from newbies and traders that are entering in the wrong way of the market. I also used to trade these levels when I first started, and as I recall, the market will make a very shallow pullback, baiting traders to enter before continuing in the initial direction. So that's the trade plan. We won't enter when the RSI enters the overbought or oversold area. We'll wait for a shallow pullback to trap dumb traders, and we'll enter at the first sign of trend continuation. We'll use Fibonacci retracements to determine our entry area. We'll keep only the 23, the 38, and the 50% levels, because like I said, we are interested in shallow pullbacks. And we'll keep the RSI with the default settings of 14. So for a buy trade, when we see that the RSI crosses above 70, we wait for a pullback. When you have some sort of downward movement, you apply a Fib retracement from the most recent swing low to the highest point of this previous up move. You enter a buy trade at the first sign of rejection at one of the Fib levels. We'll talk about stops and targets later. For a short trade, when you see that the RSI crosses below 30, again, you wait for an upward pullback. Then you apply a Fib retracement from the most recent swing high to the lowest point of the previous down move. You enter a sell trade at the first sign of rejection at one of the Fib levels. Let's test this theory on Forex market, Euro-USD 15-minute time frame. I see an uptrend, with market making higher highs and higher lows. The RSI lags behind price and also moves with a steady upward slope. Now we have the overbought signal with the RSI crossing above 70. Remember the plan. We'll buy after the market makes a pullback to one of our Fib levels. So let's apply it. This is the most recent swing low, and this is the highest point of the current trend. and that's our buy area. Okay, we have the rejection, a massive engulfing bar rejecting the 38 fib level. Stop loss goes below the 50% level, and we'll aim for a 2-to-1 risk-to-reward ratio. Now I see another potential trade. Our previous take profit coincided with another overbought reading on RSI. So let's apply our Fibonacci once again. This is the most recent swing low, and this is the highest high in the current trend. Our buy area is here. We have our first green candle, but this is not a bullish candle I expected. Let's wait for further confirmations. Price went below our buy area, and here's a bullish engulfing candle. Even though price is below our buy area, we are still buying at a discount, so there's no reason not to take this trade. We'll put our stop loss below this low, and we'll once again target a risk-to-reward ratio of 2. Let's move to stock market. Apple, 15-minute time frame. I see a break of structure here. Market is making lower lows, so this might turn into a downtrend. Here's an oversold signal with RSI crossing below 30. So the plan is to sell after the market returns to one of our fib levels and we see some sort of rejection. This is the most recent swing high, and this is the lowest point of the current trend, and that's our sell area. And here's the rejection, an engulfing bar rejecting the 38 fib level. Stop loss is placed above the 50% level, and let's aim for a 3-to-1 risk-to-reward ratio. And here's another potential trade. After our take profit was hit, I see another oversold reading on RSI. So let's apply our fib once again. This is the most recent swing high, and this is the lowest low in the current trend. Our sell area is here. We have the first red candle, but let's wait for further confirmations. Okay, now I see this bearish engulfing candle, which is the ideal entry. We'll put the stop loss above this consolidation, and we'll target a risk-to-reward ratio of 3. If you are a beginner and maybe you don't have the intuition to detect the main trend, or you want fewer signals, you could add a moving average. So let's apply a 50-period exponential moving average to determine trend direction. This is done by simply observing the location of price in relation to the moving average and the slope of the line itself. When a market is in an uptrend, the moving average is below the price action. In this case, you look for overbought RSI signals and target long positions. You want to trade in the direction of the moving average and try to profit from traders shorting overbought conditions. When a market is in a downtrend, the moving average is above the price action. In this case, you look for oversold signals and target short positions against traders that will buy when the RSI is below 30. We trade Dow Jones on the 15-minute time frame. Price is above the 50 EMA, trend is up, so we want RSI to reach the 70 level. Here it is. Now we wait for a retracement to one of our levels. This is a textbook rejection. I will take this signal every time I'll see it. A pin bar rejecting the 38 fib level and the 50 EMA at the same time. We enter long with a stop below the pullback, and we set a risk-to-reward ratio of 2. So the key aspect of the strategy is that you don't enter immediately after you spot an overbought RSI. You wait for a small pullback and then make your move. Allow the market to trap novice traders. You probably remember what it was like to be on the wrong side of the trade. You enter, and the market actually gives you the impression you made the right call and goes in your favor for a bit. And then it aggressively moves against you. That's why you wait for the retracement. You want many trapped traders to be caught on the wrong side. This is Euro-Yen. Price was trading below the 50 EMA. Market is making lower lows, lower highs. Now let's mark the areas when the price entered oversold conditions. Observe how each time the price kept on trending downwards. That's why fading these levels is the better trading approach. Most traders who aren't experienced will buy the market. You need to reprogram your mind if you are tempted to trade these levels the classic way. A trend can and will keep going for a very long distance even though the price is in oversold territory. So from now on, you'll use overbought and oversold as an additional trend continuation signal. Here's another important tip. The longer the RSI stays in an overbought or oversold state, the less effective the RSI is. Let's look at this example. RSI was below the 30 level for over 10 candles, which is significant. Lots of traders enter long during this period. So when we had this retracement to the first fib level, and we saw this bearish engulfing candle, this was a good opportunity to short the market in the direction of the main trend, which was obviously down, with price staying below the 50 moving average, and its slope was pointing downwards. Time can also impact the RSI reading, so don't forget to take it into consideration as well. This strategy is more suited to day trading and scalping, and not so much to swing trading. On lower timeframes, traders are more impatient and more reactive, more emotional when the market goes against them, so they have the tendency to close trades prematurely, or they use small stop losses, which will be the main fuel for our positions. So stay on the 15-minute or the 30-minute timeframes. The entry trigger is also important. I prefer engulfing candlesticks, rejecting a fib level, but a pin bar also works well. Ideally, you should be able to gain at least double the risk you are taking. But in some volatile markets with many swings, a lower risk-to-reward ratio of 1.5 might be better. And of course, instead of RSI, you can try any indicator which allows for overbought or oversold readings, like stochastic, CCI, or Williams percent range. You just have to slightly adjust their settings to suit your markets. And you can also change the length and the type of the moving average. I use the 50 EMA, but you can apply any moving average you prefer. So adjust this technique to suit your markets and use overbought and oversold signals as an additional trend continuation pattern. If you want to see more videos like this one, leave us a like and subscribe. And check out our Academy program if you want to further level up your trading. Until next time.